There's a number of different types of loans, as you can see on the screen. This varies from unsecured, I suppose, to various kinds of property lending and even lending, as I've mentioned earlier, against business cash flows. In the early days of private debt for us at TAMIM, we did run a number of closed-ended funds which focused on unsecured lending. And while all of these investment solutions were actually quite successful and profitable, we quickly learned that, bizarrely, you were able to get a better rate on loans where you had security versus the rates we were earning on loans which were unsecured. And we also figured out that in Australia, the level of protection given to lenders in an unsecured transaction was actually really quite. A lot of our due diligence on the underlying portfolios of these unsecured managers revealed to us that the credit work being done on borrowers was pretty substandard for those portfolios. And every now and again, we'd come across a borrower that was granted a loan when, if you had a look at their bank statement, you'd find deposits into gambling and betting accounts. For us, that's a red flag, and we certainly did not like what we're seeing there. The other thing that we noticed, which was quite relevant, was that on the recovery side of unsecured lending, because the loans tended to be quite a lot smaller than what you see in the secured part of the world, if a loan went bad, it was really too expensive to get in there and recover the loan through legal channels. So today we stay very far away from unsecured lending, and although the portfolio has an ability to put a small allocation to unsecured loans, it's not something that we do. With lending, which is secured by property, we find that we're able to tailor strong security on the loans. And typically we do that at low loan-to-value ratios, close to about 60%. Also, there's a very good legal system which allows you to step in and take ownership of property security in the case of a default by borrowers. Interestingly, we also found some good loan portfolios which, as we've mentioned a couple of times now, focus on business cash flow lending. A really good example of this is in the manager that we'll talk about shortly in the presentation. We've historically lent funds to a recycling business which had a number of contracts with local councils for recycling. The banks wouldn't lend to these guys as the company was relatively new and it had only been operating for about 12 months. And even though the operators of the business had run it previously for a significant amount of time before that, the bank was not able to look through that requirement of a business having an operating history of greater than 12 months. The interesting thing with this particular business is that it actually had 5-year locked-in contracts from local government bodies. So no need to tell you the loans never missed a payment. They were paid on time at the end of the loan period. And the banks ended up missing out because their checklists or their crazy regulations wouldn't allow them to assess the real risks inside of this transaction.